Welcome, everyone. We're doing a deep dive today, looking closely at some material you shared, specifically Mansi's trading tip number 69.
That's right. And this one really zeroes in on something quite important, the whole risk-reward idea. When you're considering a stock that's, well, way up above its 200-day simple moving average.
Okay, the 200-day SMA. Let's quickly unpack that. For anyone listening, think of it as a kind of baseline. Yeah, it's the average closing price over the last 200 trading days.
Exactly. It helps smooth out the short-term bumps and gives you a clearer view of the stock's longer-term trend. Is it generally heading up or down?
It's a pretty standard indicator used by a lot of traders and investors.
Definitely. So Mansi's tip is specifically about when a stock's current price is, significantly higher than that long-term average. What does that mean for someone thinking about buying in?
Right, so now we've got that baseline. Let's get into Mansi's main point, this idea of being cautious when the stock price is really stretched above the 200-day.
And it all comes down to that risk-reward ratio, doesn't it?
It does. Mansi's suggesting that when a stock is already flying high, way above that average, you really need to look hard at what you might gain versus what you might lose.
Well, think about it logically. If a stock's already had a huge run-up, the chances of another massive jump, at least right away, might be, well, maybe less likely.
So the potential upside, the reward part, could be somewhat limited.
Potentially, yes.
Yeah.
The easiest money might have already been made, so to speak.
Okay, that makes sense. But then there's the other side of the coin, the risk.
Exactly. Because if a price is stretched really far above its long-term average, like an elastic band, there's a greater chance it could snap back.
Right, meaning a price correction, a fallback towards that 200-day SMA line.
Precisely. That possibility, that risk, becomes more significant. It's like gravity pulling it back towards its longer-term trend line.
And Mansi puts it very directly. The quote is, "When you enter a stock which is far above its 200-day SMA, risk-reward ratio is not much in your favor."
Yeah. Pretty blunt. So the core message there is high price relative to the average often means the odds might be tilting more towards risk than reward. The easy gains perhaps gone, downside potential increased.
That's the crucial insight, yeah. So if that's the situation, what's the practical advice? What does Mansi suggest you actually do?
Well, tip continues. Buy only a little quantity, never be fully in.
Okay, let's break that down. Buy only a little quantity, why start small?
It makes a lot of sense from a risk perspective.
Yeah.
If you take just a small position and the stock does keep climbing against the odds, well, you still participate in some of that upside.
You get some skin in the game, but you haven't bet the farm.
Exactly. You're not risking a huge chunk of your capital right away.
And the second part, never be fully in. That sounds like a strong warning.
It's about capital protection, isn't it? If you avoid putting your entire intended investment into the stock at that potentially peaky price point,
Then if it does correct, if it falls back towards that 200-day average like we discussed,
your losses are limited. You haven't exposed your full capital to that significant drawdown risk. It's a defensive move.
it's important to stress, though, this isn't Mansi saying absolutely never buy a stock above its 200-day SMA, is it?
No, not at all. It's more nuanced. It's about adjusting your approach based on that specific condition. Be more cautious, manage your risk more actively.
Right. It's a suggestion for prudence, not an outright prohibition.
You might still see a short-term setup you like, or maybe your fundamental analysis strongly suggests the stock should be valued much higher. This tip is just one factor, focused on the technical picture and risk balance.
Which does raise the question, and this is maybe something for you, the listener, to ponder. Are there times when this advice might not apply as strongly?
That's a good point. Could there be situations, maybe in a roaring bull market where everything is lifting, or with a truly revolutionary company, where being more aggressive, even above the 200-day, makes sense?
Or maybe the 200-day itself is rising so steeply that being far above it isn't quite the same warning signal.
Possibly. It highlights that context matters, right? Your own research, your risk tolerance, the specific stock story, the overall market mood, they all play a part.
Mansi's tip gives you a really valuable framework for thinking about that risk-reward, especially in that stretched scenario, but it's not the only thing to consider.
Absolutely. We've all seen stocks that look extended and just keep going, but we've also seen the ones that pull back sharply. This seems aimed at protecting you from getting caught badly on those pullbacks.
Okay, so let's try and summarize this deep dive into Mansi's Trading Tip 69. The main idea is pretty clear.
Yeah, when a stock price is significantly elevated compared to its 200-day moving average, be aware that the risk-reward balance might not be in your favor.
The potential for more gains might be less compelling compared to the increased risk of a pullback towards that average.
And the practical suggestion stemming from that is caution. Consider starting with smaller position sizes. Don't go all in immediately.
It's a really neat example of how a simple technical observation can prompt deeper thinking about managing risk.
Which is absolutely fundamental, isn't it?
Yeah.
Whether you're trading short-term or investing for the long haul.
Definitely. It's a constant balancing act. Okay, so here's a final thought for you to take away. How does this principle, thinking about where a stock is relative to its long-term trend, like the 200-day SMA, fit into your own overall investment or trading strategy?
Yeah, how might you apply this idea or adapt it depending on different market conditions or the specific types of stocks you're interested in? Something to mull over.